Investment rental return rates, or yield as it's often known, is something that landlords use to calculate the value of their property and investment. So it's generally a cost of the property. Let's say it's £100,000. If you rent it out and you're obtaining £10,000 a year in rent, then your yield or return is 10%. It's also worth knowing, of course, that in 10 years, if you carry the rent on at that rate, the property has paid for itself. So you can see why people like buying property to invest in. It's important to remember, though, that yield generally will be gross or net. Gross being your £10,000, that's all the rent that you receive. The net is actually what you might, in theory, be able to put in your pocket. And that's normally a hell of a lot less than the gross rent, because you've got lots of things to come out of it, like building insurance, perhaps interest on the mortgage that you've got on the property, any repairs that you carry out, and any periods, for example, when the tenant isn't in occupation and you're receiving no rent whatsoever. So generally, there's a big difference between gross and net yield, well worth bearing in mind if you're thinking about buying.